Welcome to our very first presentation online. This presentation is an extract of the presentation done at Insight at February 2019 down in Howick. And really we want to look at profits, dividends and share prices and really understand why price change doesn't need to mean income threat. And this is particularly pertinent after 2018. So I'm going to jump right in. My first chart has two charts, and I'm charting the top 40 in both cases. Now the top 40 are the top 40 shares on the JSE, calculated by market capitalization, but important to say they're the 40 most valuable companies on the JSE by total number of shares in issue by price. So if we have a look on the left hand side, we see the top 40 shares, their price change during 2018, and I've circled there the red blocks, which really just highlights that we have, and by far the vast majority of the shares had declines during 2018, some of them quite severe, more than 40%. If I look in the right hand side, and I've highlighted now with a black circle again, we're looking at the change in the dividend payment during 2018 versus 2017. So you can see when I compare the two, the left-hand side, we've got a vast majority have declined in share price, but at the same time, those same 40 shares have largely increased their dividend during the 2018 year, and very few actually have declined their dividend. There are some, but by far the majority have increased it, and that really speaks to the Harvard House investment philosophy of trying to separate capital change from income payment. So let's look at this components of return, and it's sometimes the share price and the total return can hide the picture of the underlying company. So we look at basically four snapshots here. The first one is the overall JSE as a whole. The second is the basic resources sector, which is largely the mining and minerals sector. The third one is financials, which would be your banks, your asset managers, your insurance companies, and then finally your industrials, which would be pretty much everything else, the guys who make stuff, who move stuff around and offer services in that space. So there's four blocks for each sector. The first one is the total return. The second one indicates the change of profits during 2018. The third one indicates the change of rating, or how the market sentiment is seen on the share. And the final one would be the dividend payment during the course of 2018. So let's delve into that a little bit closer, look at one of the sectors, and I'm going to take the industrial sector as my sector of choice. So if we have a look at the total return there with my black arrow coming up, we saw a total return of just under 20% down in the sector. And what's so perverse, and the thing that we always like to point out to investors, is that the blue block is that in spite of the fact that total return went down, profits actually grew quite substantially in the sector, which is a good sign. So what really happened to lead to that total share return decline in that space? And that really is epitomized by the red block, which indicates the change in rating. Now, the way we measure rating in markets is generally what's known as the price earnings ratio. And very simply put, I like to describe it as the number of years of current profits the investors will pay to own a share. So if I'm prepared to pay 10 times the current profit to own a share, then that's my price earnings ratio. But if my rating declines, it means new investors are no longer prepared to pay 10 times, they maybe decline and pay 5 times. And so we can see there's been more than 40% decline in the rating. And then finally, the final black arrow pointing to the fact that in spite of the rating change and negative sentiment, the shares in the local industrial sector still paid dividends. And you can see they're fairly low, but this sector is overshadowed quite considerably by Naspers, which pays a very low dividend in that space, which is why it probably looks fairly small. So let's drill down into that a little bit further, and I'm going to take probably our biggest shareholding at Harvard House, which is British American Tobacco. British American Tobacco probably exists in almost all client portfolios, and there you can see in the left-hand graph I've got the same blue block, which shows a total return of almost minus 40% in 2018. Rather a depressing statistic for investors, and certainly Harvard House investors. But we can see that in spite of total negative return, British American Tobacco actually grew its profits last year, which is always a good sign of the underlying business. But where the trouble really came was in the rating, and we can see that there's been change in the sentiment by almost 50% over the prior year. What has driven it in that space? Well, to get more specific and illustrate how these things work, a lot of the concern in this space has been around regulation. The American regulators came out during the course of last year and said that they were going to quite aggressively attack menthol cigarettes, and British American Tobacco sells a lot of menthol cigarettes in America. So that was one impact. This is another impact which was fairly significant, is what we would call the new generation products, and those are the vaping or the electronic cigarette options. And there appears to be some concern around take up among the young adults in this space, and possibly even underage, and so there was some threat of rather draconian regulation. Plus, on top of that, no one's really sure how successful the new generation products are going to be. So sentiment is a big factor in this space. And then finally, you can see that the dividend was healthy and paid. And really, for investors who are living on income, the dividend is the most important part. So moving across to the right-hand graph, we can see that the light blue line just tracks the share price of British American Tobacco over the period. The black block is the calendar year 2018, and you can see top left to bottom right, the share price has just reflected that big decline in the share price. But the red line indicates the dividend payment, and this is something that we continually point out to investors, Harvard House investors, that when you're living on the income and the income continues to increase, you can certainly be patient around the share price. If the business model is good, it's likely that sentiment, and when it's sentiment that changes, it's not the profits of the company, it's actually the sentiment, and that sentiment can turn as quickly as it turned down, it can turn up. But in the meantime, we're collecting an increasing dividend. Now you can see there's 4 steps there, and that really is indicated because British American Tobacco changed to a quarterly dividend payment during the course of the year. And you can see that is nice and healthy and increasing. And so we would just emphasize that, again, our investment philosophy is based on a separation between the capital change and the income payment, because income tends to be far more steady and capital changes tend to be a lot more volatile, and you can see that certainly in the graph there. So I trust that was enlightening. If you want more information, please feel free to jump onto our website and get in touch with us through there. Thanks for your time.